It has been nothing short of a dismal week, with shockwaves of fear riddling through the stock market as we sat all week long in the red.
Last week, that was the worst week for the S&P all year long. Well, scratch that. This week is now the worst week for the S&P 500 all week long. A break below 5,000, a line in the sand that a lot of people have had their eye on, a big drag coming from big tech. In fact, on a weekly basis, barely 100 companies in the S&P actually managed to finish out the week in the green.
So as we always do, I want to go ahead and kick us off with our need to know economics that will then hopefully deliver all of you with some peace of mind so you have that generalized understanding of what the heck happened this past week before covering 7 dividend stocks that are not only on my hot list, but are imminent buys as they all faltered to discounted share prices recently. With that, let's get right to it. So the first question for all of us as investors should be asking ourselves before we go on any sort of buying spree, what in the world happened this past week? Now, in doing so, and furthermore, coming to an understanding of our economic backdrop, we're not only going to be more secure with our investment strategies and what we're investing into, but most importantly, we're going to be able to avoid the gut-wrenching nerves that typically get the masses of average Joe investors to panic sell. In other words, knowledge is our power. Now, here's really what I want you all to know, our market mandates, as we always talk about here on the channel: inflation and interest rates. Now, in other words, if inflation goes up, which it just did to 3.5% as of the latest report, the market will react negatively. And on the other hand, when it comes to interest rates, we're all awaiting the green light from the Federal Reserve to ultimately lower rates. That will be the green means go light for all the bulls out there. But Powell remains steadfast on holding rates steady. And that's where there's just now a lack of confidence with all the data that's been coming out. For example, we just had a glimpse into the mind of the consumers, all of us, whereas we're still seeing a lot of spending, meaning our economy is not exactly cooling down. Now, that's not a great sign for the Federal Reserve to actually lower rates. And on a global scale, well, I think it's safe to say that the world war of the Middle East has commenced officially after Iran attempted to blow Israel off the map, though the hundreds of suicide drones and missiles were arguably the biggest flop in all of history. Israel's response, which all I'm going to say here now is, well, around and find out. But the world is watching. The market is certainly trembling because, heck, there's implications. Oil's spiking, and you see that sneeze that occurs across the globe, as we saw during the pandemic, certainly and very likely always impacts you wherever you may be. But as an optimist and a long-term investor, all the headlines that are meant to scare me actually entice me to do one thing and one thing only: buy the dip, which is exactly why I now have 7 dividend stocks that made their way onto my buy list to share with all of you. The first is Home Depot, ticker symbol HD, which is our home improvement juggernaut that right now is really suffering from the pains of consumers rain checking their DIY projects, and with the economy exactly where it's at, home builders are actually pacing themselves as well. That gives way to a very depressed share price, coming in at $332 per share. That's down from almost $400 per share earlier this year. PE ratio here at 22.4. But zoom out with me to see how a home builder or home improvement retailer like Home Depot fares over the course of a decade, with over 426% worth of appreciation. Now, as for analysts right now, they too are bullish, with 17% worth of upside forecasted, coming up to a share price of $391.41 per share. And until then, we're going to reap the benefits of a 2.7% dividend yield that's growing quite quickly, if I may add, by 19% year over year while maintaining its 36-year dividend streak. Now, moving right along, I want to go ahead and talk about some benefits when you invest into McDonald's, ticker symbol MCD. It's the world's fast food kingpin that has gotten a whirlwind of attention rather recently, not only for their menu price hikes while also being roped into Middle East politics, but just overall consumers now penny pinching and pulling back on spending, all of which led to an 8.4% decline on the year, with the share price at $269 per share. Though long term on McDonald's is going to be looking green. We see over 253% worth of share price appreciation this past decade, and in the interim, hedge funds have certainly been loading up on McDonald's as well. Analysts are also very optimistic, with over 20.3% worth of upside expected, bringing that share price up to $324.95 per share. And until then, how about a McDividend? As a yield will come in at 2.47% with plenty of growth, about 15% year over year growth over the last 20 years. But that's overall here 47 years worth of a dividend streak. Now, if McDonald's is a bit too expensive for you, whatever that means as an investor, I want you to look into Starbucks, ticker symbol SBUX. Starbucks, which has become the dominant coffee house chain globally and continues to expand their global footprint and innovate. Yet it actually faces all the same troubles that McDonald's does, which means right now we have Starbucks trading at a bit of a discount after faltering by 9.67% on the year, trading for $86 per share. But again, it's all about the long term here when it comes to Starbucks. 191% worth of share price appreciation, plenty of bullishness right now coming in from the analysts with Starbucks. That's up at a forecasted share price, topping $107.22 per share. About 24% worth of appreciation to enjoy, all while you get a grande dividend year coming in at a yield of 2.64%. That's been on an ongoing streak for the last 13 years now, while averaging 17% worth of year-over-year growth over the last 10 years. Now, investors, there's 3 out of the 7 dividend stocks, so we got 4 more left. But right now, it's all about taking some action. Real, live, massive action by subscribing to the channel, which will ensure that you're going to get all the market insights that you need and dividend stock ideas to fuel your financial freedom journey. And moreover, I want to ask that you actually tap on that thumbs up button for me if you're gaining value from videos like these. That tells me to make more videos just like this one, so it's a win-win for the both of us. With that, dividend stock number 4, let's talk JP Morgan, ticker symbol JPM, the largest bank in the industry, at least within the United States, but with a massive global influence, which has been sliding rather recently. See, it fell from around $200 per share down to around $180 per share right now, PE ratio at around 11. But zooming out for the big picture, we see over 326% worth of share price appreciation. However, the question comes down to, why did the stock slide? Well, it came down to near-term guidance that was, unfavorable to all of us shareholders. But remaining long on JP Morgan, I only see opportunity here. And a matter of fact, so to the analysts, with over 15% worth of upside expected, that would bring us back up to a share price of $208.47 per share. And until then, you will get a solid dividend yield coming in 2.55% worth of a yield that's been growing on average by about 6% year over year for uninterrupted dividends over the last 14 years. Next up, a healthcare provider that I certainly cannot stop talking about. It's United Health, ticker symbol UNH, which is already this past week working its way back up. As we can see right now, it jumped almost 8% this past week, yet still down year to date, trading for $478.99 per share. But most impressively here is the overall history, with 636% worth of appreciation over the last decade. And United Health, though it was hit with regulatory probes, a cyber attack, and a major hit from a medical bill that cut down on costs, but we're already seeing that this healthcare leader is climbing up on the week. So I just wanted to share about it before it's too late for all of you. As for analysts, they too are singing buy, with over 25% worth of upside expected. That would bring the share price back up to $599.14 per share. And from there, those waiting to reap those benefits would also collect on a 1.57% dividend yield. It's been shelled out for the last 31 years, while growing on average by 41% year over year for the last 20 years. Now, investors, I want to head back into the tech sector to close up shop with you for today. 2 opportunities here. The first is T. Rowe Price, ticker symbol TROW. It's not directly a tech player. It's an investment into an investment management firm that spans all of its assets across the NASDAQ, meaning when tech does well, T. Rowe Price does great. But when tech does not do so well, we have T. Rowe Price on the week sliding. So we can take a look here and see that T. Rowe Price slid to $111 per share with a PE ratio now at 15.7. Now, year to date, we remain up, and I would imagine after all is said and done, we're going to continue to see an upward trajectory here with T. Rowe Price, as we've seen this past decade. But don't just take it from me. I want you to go ahead and look into what Smart Money has been doing, because they've been making a ton of money moves on T. Rowe Price. And my favorite part about investing into T. Rowe, the dividends. It's coming in with a strong dividend yield at 4.45%. That's an average growth rate here of 14%, while on a dividend streak for the last 37 years. And if you want to invest just directly into one of the Mag 7s for more growth orientation while still capturing a little dividend, my recommendation is to look into my personal favorite, Apple, ticker symbol AAPL, which doesn't need any sort of introduction. But it hasn't been faring all too well rather recently, as sales in China went down, overall macro declines based on demand, and all the alike. But think about the future. It's bright for Apple, and I foresee Apple as an AI leader with continued modernization in tech and just overall tech leadership. So we see Apple down right now, trading for $168 per share, which is down by about 12% 12% on the year. Give it some time though. After all, we can zoom out here to see almost 1,000% worth of share price appreciation, along with analysts who remain bullish right now with over a 17% worth of appreciation expected, climbing up to $197.38 per share. And until then, a chunk of a dividend here coming in at 0.57%, an 11-year track record thus far of uninterrupted dividends and a steady 9% growth rate during that time as well. Now there you have them, all 7 dividend stocks. Drop your thoughts on each of them down in the comments below. Let me know what you're actually focused on buying this upcoming week as well. Catch more insights right here or just subscribe to catch all of my latest.